Okay. We need to distinguish the total debt versus total liabilities. The company's total debt includes both short-term and long-term interest-bearing liabilities. Long-term interest-bearing. However, the total liabilities only equal to the total debt plus the company's free non-interest. Okay? So in here, when you say debt, it includes only the interest-bearing. When you say total liabilities, it includes also the non-interest bearing. Okay? So therefore, as you can see, the total debt is the short-term debt plus the long-term debt. 110 plus the 70. This is it. This one and this one. Okay? So in here, that's 860. If we're going to add these two, here you can say 860. However, in the total liabilities, this includes the two. Okay, so therefore the total liabilities is 1 billion and 60. Again, the term total debt includes only the interest bearing. The total liabilities includes all the liabilities, the interest bearing and non-interest bearing. Okay, for the other sources of funds, basically this is a combination of the short-term debt and the long-term debt. Again, when I say debt, those are interest-bearing and also the common equity. However, there are hybrid securities like the preferred stock. The preferred stock is an equity, but there is no voting rights of this. And we have also convertible bonds. It means to say it has a features that you can that gives right to the bondholders to convert the bonds into another security. Long-term leases. This is also another financing. Like instead of acquiring assets or long-term assets like a plant, you are going to lease them in a long-term basis. Like in the next 20 years or 30 years, it will make the lessee, the one who rent the property, as in substance an owner because it is a long-term lease. Yeah. So why is it that it is called also as other sources of funds? There is no funds actually that you get from the long-term lease, but it helps you to avoid using your money, okay, because of the lease. So instead of giving, like if the worth of the plant is 1 billion, so instead of giving that outrightly, you can rent that like over 30 years for like 10 million a year, example. So okay, moving forward to the preferred stock, it is a hybrid between the common stock and the debt because preferred stock has a preferences when it comes to the liquidation. It means to say that when there's a money remain after exhausting or after paying all the debts, the preferred stock will be paid first over the common stock. That's why it is a hybrid between the debt and the common stock. It is an equity. It can receive fixed amount of dividends, but it's not a debt. It's not a debt of the company. Okay. Debt. While convertible bonds are debt securities that give to the bondholder option to exchange into bonds or shares. So that's what I said earlier. In the event of bankruptcy, so this is the hierarchy of what I mean, the preferences of the settlement of debt, or I mean liquidating the cash or assets of the company. First, pay the debt. Second, pay the preferred stock. Third, pay the common stock. That's how the steps on settling the, what you call this one, those that are the obligations of the company. In the depreciation, there are two set of rules. The one first is governed by IRS in the United States, and the second is governed by the GAAP. Let's say the GAAP, you can use straight line. In the IRS, there's no straight line. You have to use the accelerated depreciation. They have the fixed calculation of that, and it will give rise to a timing difference of the tax. That's why there is what they call the tax liability, and also there is a tax asset. Okay, so that's the timing difference. Okay, second, we have the market values versus book values. We have to take note, again, we have to take note that the GAAP is governing the reporting of the balance sheet. Okay? Now it doesn't care about the perspective of the market value when it comes in the financial markets. The GAAP is only based on the book values according to the standards. Okay? Now, if there are some market value of the assets, then there is another principle of the GAAP that will govern that on how to reflect the market values. But so far, the usual rules for that is the lower of the whatever given, the lower of the book value or the market value. So for instance, if the book value is saying that your inventory is worth 1 billion, however the market value is saying is only 980 million, then you have to follow the lower. Okay, that's the usual rule when it comes to GAAP versus the market value. And lastly, in this section, there's a time dimension. So when you are going to report a balance sheet, for you also to be informed on how to read the balance sheet, when it's say an annual, there's always a cutoff of that. So if you can see in the here in this, the cutoff of this Intel balance sheet is December 30, 2023. So it's not talking about December 31, 2023. It's talking as of December 30. Means to say, if we're going to confirm their balances as of December 31, it should be exactly, or it should be around, or exactly 7 billion, like that. Okay, that's how it is. In every balance sheet, there must be a time dimension, because balance sheet is a snapshot of the firm's financial position at a point in time. Again, at a point in time snapshot. So try to appreciate this one. This is how we are going to understand the company itself, that the company is worth 191 billion. Okay, and and the total assets and the total liabilities is having 20 sorry 20, it's not stated in here, but the total current is 28 and the total debt is 46. Okay, so that would make the total liabilities and stockholders equity as to 191 billion. So take note of that. We're talking about December 31, and this is the snapshot of the company. This is how we read about the company. It's so large. It has current assets of like not more than the PPE or the fixed assets. It's like half of the fixed assets. So they more invested into fixed assets. They have a lot of goodwill. Means to say they have a lot of potential in the future, because this is a technology, and the company is based on research, and then they sell whatever their output of this research and development.